The trading principle is all about learning to identify a key auction reversal. Now I'm just going to show you what it looks like. So a key auction reversal tends to look like a V. Okay, for those of you who've been following me for a long time, you would have heard me use the word a V-shape reversal. Okay. Now, what a V-shaped reversal is what we call an equal and opposite. In other words, the way the market sells off in terms of structure and in terms of how it looks and in terms of the way the sellers are selling is the same way in which it reverses. So we see very aggressive selling, and then we see equal and opposite. We see very aggressive buying. Okay, and that's what we call an equal and opposite. Now, it's also known as initiative to initiative, and this is dealt with, I would like to think, for a good half an hour or an hour of the entire course. We talk just about initiative and what initiative is, how it's created, why it's created, what the purpose of it, what is implied, and it's an extremely important, principle in all trading. Okay, initiative, type response, price response. But the basic essence of initiative is simply that on the down move, we have sellers initiating. In other words, they're taking it upon themselves to be aggressive in nature. Okay, they're initiating, they're influencing price to the downside. Now, when there's initiative, right, there's very little responsive behavior. Now, responsive is exactly what the word says. When prices move, you have other participants participating. Okay, now, when there tends to be initiative, which is high volume in nature, very aggressive, you don't see much responsive from the other side. In other words, there's a very big volatile move in one direction because no one is willing to provide the liquidity to that initiative. Okay, now the equal and opposite looks similar. So once it starts to reverse, okay, in the initial phase, we see quite a lot of responsive behavior. Why? Okay, because we've got a lot of buyers caught in this down move that are simply looking to liquidate on the first bounce. Okay, so we initially see responsive behavior, which then turns to very aggressive initiative behavior. Now, don't panic, I'm going to show this to you an example in a minute. Okay, so like I said, the characteristics of a key auction reversal, high volume, has to be high volume. Okay, why? Because initiative by its very nature is very big time frame players. Okay, and if big time frame players are influencing price, it's high in volume. They're bringing a lot of business to the market. Okay, we're also going to see a delta reversal, and I'm going to show you what that looks like. In other words, we'll see a lot of negative delta on the way down. Why? Because sellers are very happy to hit whatever bid they can. Okay, buyers are not going to lift offers, so there's no buy side delta. There's only aggressive sell side delta. Okay, but what we see in a key auction reversal is a very aggressive shift from a very negative delta, not just a negative delta, from a very negative delta to a very positive delta. Okay, so it's almost extremes, opposite extremes that occur in a key auction reversal. Okay, and like I said there, it's initiative to responsive. Sorry, that should say responsive. So it's initiative to responsive initially, but then becomes initiative thereafter. And again, I will show you this in a minute. Okay, now it's important to discuss the implications going forward because a lot of people tend to think, oh, I missed an opportunity and it was the low and now I'm never going to make money. I was buying it the whole way down, etc., etc. But there's very strong implications to key auction reversals. And again, I discussed this quite thoroughly in the Footprint course. Now, the number one rule with a key auction reversal, there's a high probability for continuation in the direction of the key auction reversal. Okay, again, note what I just said there. There's a high probability. Okay, this is based on the back testing process or the forward testing processes I'm going to show you guys a little bit later on. Okay, also, if we take out this key auction reversal, if we take out that low made on Friday, the 19th of October, okay, you are going to see a very aggressive response. Why? Because anyone that's now long, anyone that's bought higher up, anyone that bought lower down is going to be panicking out. Equally, you're going to see very big time frame players enter the sell side momentum. Okay, so you will get a very aggressive move through that key auction reversal. Right, so straight away what you should have picked up on there is just because you've missed the Friday move, right, that means nothing because the real moves are now come Monday the 22nd of October. Okay, so the strategy we'll talk about is day 2 continuation. I'm going to show you how the execution of this works, and I'm also going to show you where you want to be looking to be a buyer of those BTPs given the key auction reversal. Okay, so our example is from the BTP, Italian BTPs. Okay, this is the Italian market for the 19th of October 2018. Now, why I like the BTP in this example is a lot of people always ask me, can the footprint be used in any market? Well, the simple answer is yes. Okay, footprint is just showing you how the buyers and sellers are interacting. It's not the holy grail. It's not, giving you signals. It's telling you, okay, you think this is an area where, there should be buyers because the candlesticks tell you that. And the footprint just tells you, yes, there are buyers. You were correct. Okay, so it's almost a complement to other tools of footprint, right? It's not a signaling service. It's a confirmation. I expect buyers, because I've got support, and therefore, the buyers step in. Therefore, I can now buy the market. Okay, so what I will say as a caveat, one of the biggest mistakes I made early on in my career, okay, was I used to pick bottoms. I used to think, oh, this is a good low. Oh, this is a good area to be a buyer. Oh, this is support. Let me buy it. Let me stand in the way and provide liquidity. Now, a lot of you do that week in, week out, and hopefully you're honest enough with yourselves to admit that, okay? The moment you can step away from providing liquidity to the market, and instead have the idea in the back of your mind that this is a key area where I'm interested in. Let me watch the interaction with the footprint. If buyers step in, I step in. Otherwise, okay, all I have is a line. A line created by what? Okay, and that's the key takeaway. Don't be fooled into thinking you can just buy support. That's absolute balderdash. It's absolute rubbish that all these wonderful gurus teach you. Okay, take it from someone that actually makes money as a trader, that makes money doing and fading a market. There is a time to fade, but by golly, don't fade randomly. Don't just put liquidity in the market where you think there's support. Put liquidity in the market when a buyer steps in, because when a buyer steps in, then it's time for you to buy, not when there's still sellers selling the market. Okay, now let's get to the example. Let's talk BTP. Now, what I want to do before I get the footprint up, let me just show you what it looks like on a candlestick. And I like to do this because a lot of you can relate to it. So, what you can see here is the really important low that we had at 118.26. Okay, it was set back in early October. It had become quite important to the market, and the market was becoming quite fixated on that 118.26. Now, what happened was we opened the next morning, and we could see straight away, just the initiative begun straight away, and we can call it initiative simply because note the red candles for one. Notice the complete lack of overlap. So overlap just simply means how much of the previous candle does the current candle overlap, and you can see that in this entire rotation, not once have we taken out the previous high. Okay, that's almost 10 hours of work. Okay, note this is a 1 hour chart. Right? We then have a little bounce, and again, what do we see? 1, 2, 3, 4, okay, 5, almost 6, 7, 8, 9. So about 12 red candles and 2 green. Again, that initiative continues. So a very aggressive surge, very, very aggressive sell side action. From pretty much the open of Thursday all the way until sort of 9, 10 o'clock on Friday morning. So very, very strong initiative, very strong sellers. Now this is the equal and opposite, okay? So as we came in, notice now how many greens? 1, 2, 3, 4, 5, 6, and 2 reds. Okay, so we've got a lot of red and no green, a lot of green and no red. We've got a lot of, or a lack of overlap on the way down, and we've got a lack of overlap on the way up. Equal and opposite. Initiative, market bounces, what do we see? Responsive behavior, that's where the sellers step in. What are they doing? They're simply just getting out of those positions that they're caught in. So that's why we get the response there. Once that response is done, we get the initiative. Okay, that's the structure of initiative to initiative with a response in between. Now, let's look at the footprint. I'm going to take you through this. So the first point I want to look at is that 118.26. Why? Because it's a key low. Okay, so a lot of you go, oh, there's a support there, 118.26. Let's play for a breakout. So straight away, I'm not going to discuss the breakout, but what I am going to show you is, I'm just going to zoom this out, and I want you to look at the footprint here. So the first time we break out there, what does the volume do? Okay, yes, it picks up. Does it pick up significantly? No. Okay, 100% increase. If you were to draw an average, which you can see on this blue line, okay, the average moving into that break was roughly around 1,000 contracts. Okay, so we just doubled the average. Is that significant? Well, if you've done enough footprint analysis, the simple answer is no. Okay, significance will be about 5-6 times average. Okay, so we expected an important breakout. We expected, some serious venom in this break. Why? Because of the sensitivity, because of the key level. What did we get? Not aggressiveness, not a lot of volume, not what we expected. So bad breakout, that's the first observation, a bad breakout. Now, I'm not saying you don't play for the breakout. 100% you play for the break because the risk reward is there. Okay, this is the significant break. So we could see a little further on, suddenly we get 4 times X, okay, 4X volume, and we see the delta pick up. There's the significant break, okay, a little bit of stops going off in the market. Very next candle, what do we get? Continued high volume, and we get a delta reversal. Now, this is imperative. If you want to learn about key auction reversals or how to fade a market, start looking at, the way the sellers initiate and what happens once those sellers initiate. Okay? The fact that we've bounced straight away off of that first move tells me that that down move was not a seller being aggressive, hitting every single bid. It was one seller stopping out. Okay? If that was an initiative leg, if that was real sellers stepping in, one, the market would not have a positive delta on the next leg, and two, the bounce would be far shallower than that. Okay, so straight away I can see there was some very, very aggressive stop out, but then straight away buyers latched on. Bang! Straight back up. Okay. Now notice what happens. There's that 118.26. That key break. What do we do for the next hour and a bit? We sit there, and we sit there, and we sit there. And the buyers trade blows, and the sellers trade blows, and the buyers trade blows, and the sellers trade blows. What's occurring here? Absorption. Okay, this is that responsive leg. So every time it goes bid, the sellers respond. They take what they can get, they get out of those positions. Okay, market goes down, and the buyers respond, and the sellers respond, the buyers respond, the sellers respond. Eventually, what occurs? 2 hours later, 2 and a bit hours later, suddenly an initiative leg occurs. Okay, so we get above this, and I just want to show this to you. We get above this little key area. We can see the 118.58 was acting as a real, an area where the sellers were happy, just so desperate to get out of whatever they had. It was sort of this 58s to 67s they were hanging around. Okay, eventually you fast forward 3 hours later. All right. The market has one more little look down at that 118.26. Remember that key level, that's the key break, comes down, tests it one last time, and the buying phase begins. Okay? More importantly, the initiative leg then truly begins. And I'm just going to scrunch this up so you can see what it looks like. All right, this is the start of the initiative leg at 2:30 on Friday. Okay, each one of these is a 5-minute rotation. We can see it there. How do we know it's an initiative leg? Look at the volume pickup. Okay, 4x. Massive volume pickup. More importantly, look at the delta. Okay, so we start to see the buyers turn from responsive, which they were doing for the last 2 hours, to now initiating. And that's the key. Suddenly the market goes 118.58, does a 1.5. Okay, to give you a little bit of perspective, the range on the day was just over 2 points at that point. Okay, so in a space of 20 minutes, half an hour, we did a 1.5. We did the entire day's range. That's what we're after, guys. That's the meat that we're after. Okay, so what's the takeaway from this? It's not to say that you don't fade the low. All right, what it's to say is, if you were buying the lows, look how much pain you went through. Look how much risk you took. Okay, 1, you went offside buying support. 2, you had to sit for the next 3 hours in the most uncomfortable position. Right? Had you waited for that initiative leg to come in, that last test of the 118.26s, now you've got perfect price entry. Now you can leverage up the trade. More importantly, how long are you sitting off sides? 1, you're not sitting off sides. And 2, all right, you're getting paid relatively quickly. And that is the true art of trading, guys. It's not about picking lows and highs. It's about picking the right timing when the buyers step in because you think there is key support. That is the fine art of trading.